Hello, YouTubers, friends, compatriots, bootlickers, shows, slay search, peasants, vassals, minions, meat sacks. I'm Usually welcome. Today I want to do part two in the coming economic crash. And in this one, I want to talk about how we got here. And so, my basic premise is that we had the 2007, 2008 financial crisis and the bank bailouts. And my basic premise is nothing was ever fixed. It was just pushed forward. So sooner or later, we're going to have to deal with the fact that the can was kicked down the road and band-aids were put on everything. And that moving forward from there, we're definitely going to have to deal with it at some point. And of course, we start off with the $800 billion of bank bailouts. And the reality is that, as we found out later, that behind closed doors, the amount of the bailouts was actually closer to about 26 trillion. And the Federal Reserve bailed out banks all over the world, not just the too big to fails here in the United States. And then we enacted supposedly some banking reform that was supposed to alleviate those kind of problems in the future, the Dodd-Frank Act. But it was loaded with so many loopholes that it didn't curtail bank activities and risk taking at all moving forward. And so one of the aspects of that, of course, is that the Federal Reserve took all the toxic assets off of the bank's hands, particularly mortgage-backed securities, and just stuck them in the Federal Reserve, where a lot of them are still sitting. And so at their height, they were at $2.740 trillion in 2022, and now here it is in March 2025, and the Federal Reserve is still holding 2.189 trillion mortgage-backed securities. So those are still sitting there. So if we have another housing crisis, which it kind of looks like we are moving towards, the Federal Reserve is going to have to take on a whole new huge batch of mortgage-backed securities and probably other asset-backed securities as well. And then another problem we have is that they changed a couple rules to accommodate the banks at that time. One of them was they changed the mark-to-market rules, and here it is since 2008, and we've never gone back to the original system. That's the idea that banks had to actually put the actual value of assets on in their books to what the market says they're worth, and they were basically given permission to just keep whatever deteriorated assets they have on their books at full value, and that's never changed. So we have a lot of banks out there that are holding a lot of assets that are not marked to market, and they're not on the bank's books at their actual value, and that hides a lot of problems at the banks and could be a problem moving to the future. Another problem that we have is it turns out since 2007, 2008, we've had perpetual bank bailouts. Not only did we have the repo crisis several years ago, where the banks got a whole bunch more new bailouts, but we have a continual perpetual banking bailout going on because as a result of 2008, all the banks were able to park their reserves at the Federal Reserve and get interest on it. And the last number I heard was something like $80 billion that the banks have made free money from the Federal Reserve from getting these getting this interest. And so then we also have the fact that, as I pointed out, we had low interest rates moving forward from 2007, 2008, and there's a lot of free money sloshing around. And so all the banks and the corporations basically borrowed and continue to borrow more money to funnel into risky speculations in the markets. And that's one of the reasons why we ended up in the situation we did back then. Well, that hasn't been curtailed, although the free money's drying up now because interest rates, have finally gone up. Back then they were practically zero, and they were for many years, and that caused a lot of risks. And now that the interest rates are going up, then these risks become even riskier. And so we also have the derivatives problem. And one of the issues in 2007, 2008 was credit default swaps. And now we have $193 trillion in interest swaps being held by banks. And then we also have $632 trillion in over-the-counter derivatives, and then we have $530 trillion in interest rate derivatives, for a total of 1 quadrillion derivatives held by the banks. And they've talked about that being a risk for a long time, because if the shit hits the fan and the banks get called out on having to cover their derivatives, we had a little taste of that in 2007, 2008 with mortgage-backed securities and interest swaps. But the fact is that that behavior is never curtailed. They not only have not scaled back the amount of derivatives that banks have, but they've actually gone up. So that risk is still there, and it's exponential. And so that's a problem going forward, should things unravel again on a massive scale. And another issue that just got pushed down the road, of course, was the deterioration of commercial real estate. And it started in 2008 and 2007 and 2008. One could argue earlier than that, but when you have all of these malls closing and they just keep refinancing the loans and changing the terms of the loans and pushing them forward, now we have massive office space, empty office space. We have empty malls. And when these people leave these office spaces, there's not going to be anybody to go back in there. And the same thing with the malls. When we have all these brick and mortar stores closing, there isn't going to be anybody to rent those spaces. And so we have mall properties that sell for pennies on the dollar. We have large office buildings that go for pennies on the dollar. And the day of reckoning for commercial real estate is coming up. And after all the real estate carnage in commercial spaces over the last 20 years, it's coming to a head. And that, of course, is the brick and mortar stores closing, Penny's and Macy's, all these massive closings. A lot of these stores went away and never came back. And that's continuing, a retail apocalypse. And a lot of it has to do, of course, with everything moving to online shopping and the like. But eventually, it's kind of amazing that the last 20 years, we haven't had to pay the price for the deterioration in commercial real estate. But as I pointed out, that's just been kicked down the road, and the end of the road is getting here. And so commercial real estate is going to be a problem. And right now, with 6.1 million defaults in the housing market, which will probably rise, and the stagnation of buying because the prices keep rising, and then the high interest rates, we could see a repeat of 2007, 2008. There's another housing crash, and once again, these mortgage-backed securities that are out there could end up being a real problem. And so there's a lot of things coming to head that have been baked in the cake since 2007, 2008. And as I pointed out, I've been on doom watch for 20 years now. It's amazing they've been able to sustain everything moving forward. And then we have all those pressures that have remained, and now we have all these additional pressures in the economic system globally. And that's another aspect, of course, of this, is that when you get to the actual balance sheets of a lot of these banks, they're actually broke. We've had 15 major banks go bankrupt since 2019. We've already had one more in 2025. And there's a lot of predictions that moving forward, we're going to see another banking crisis, and hundreds, if not thousands, of local banks will go under, and we'll see a big consolidation like we did before. And so this is all stuff that's been baked in the cake. And then you add all the economic pressures that we have on top of everything else, including inflation and now these new trade wars, and the fact that the economy in general, it has been fantasy land. The foundations are rotten. The fundamentals are bad, even with all this ballyhooing about how great the economy is. And then we also have the employment situation. And Certainly, a lot of people lost their jobs in 2007, 2008. We had very high unemployment rates, and then we got hit again with the pandemic, and employment kind of normalized. But now we have very few jobs out there for people. We have massive layoffs, and that's a part of trends that go back 20 years of a lot of these brick and mortar stores and a lot of these corporations that are going bankrupt or on their last legs and have been struggling. And a lot of times they just borrow and have a lot of leverage and just keep poking along. So we have a lot of zombie banks, a lot of zombie corporations. And again, this is all stuff that's baked in the cake from 2008, 2007, 2008, and before that. So these economic problems have been with us for a while. Nothing substantial was done with it. The reforms were lip service, and when the next one hits, everything that's already out there is going to be part of the quotient. So that's kind of how we got here. And the bottom line, I guess, is just that we have a fake economy. Everyone looks at the stock market and talks about how great the economy is, but anybody that's actually out there in the economy knows different. And there's a difference between the stock market economy and the real economy. And anyone that pays attention knows the real economy has been suffering, and it's been suffering for 20 years, and it's just accelerating and coming to a head now. So that's another reason why there's speculation that there's another economic crash coming, because all those issues have still been with us. That just makes the economy a lot weaker in spite of all the cheerleading, and are just going to add to a bigger fall. The higher they are, the bigger they fall. So we'll see. I saw that there was more talk about economic crash coming, and a lot of it, of course, is tied to the new trade wars and tariff systems. And some people are talking about pushing us into a recession, but other people are talking about the big one's going to be coming, and it may or may not be soon. So anyway, that's part two of my economic crash coming. I got a couple more chapters that I'll be posting soon. I'm usually, don't you be one too.